The ECB gets set to announce its latest monetary policy decision at lunchtime on Thursday, with the central bank unlikely to provide too much by way of tangible adjustments. This after last month saw a relatively busy meeting with President Christine Lagarde announcing a €500 billion increase to the Pandemic Emergency Purchase Programme, or PEPP. With me to discuss is Marc Ostwald from ADM ISI. Marc, great to see you. Sadly, not in person yet. So let's kick off with the PEPP. Obviously, we saw that increase in the last meeting. Do you see it ultimately being used in full?
Well, personally, I think they probably will have to. But I think this is sort of like the key issue, and it was already an issue at the last meeting, that there was this inference that they wouldn't have to. Mrs. Lagarde recently has been trying to sell this along the lines of there's plenty of reasons for optimism on the outlook in the Eurozone, and therefore we probably won't need to exhaust it, even if we have some near-term challenges. I think it rather reflects the fact that the ECB's well-known divisions between hawks and doves is re-emerging, and the hawks basically are not really, they weren't particularly happy with the increase in December, and they are quite resistant. Poses a big problem going forward because this idea of lower for longer and we can do more if we need to do more is definitely in question.
Yeah, so give us a sense of sort of your outlook on the Eurozone economy, because obviously on the one hand, we're learning about new strains of COVID, further restrictions, particularly on the economy. On the other hand, of course, there's the vaccine rollout. So how do you sort of weigh those two sides up when you come up with your assessment for the outlook for the economy?
I mean, I think it's pretty similar across a lot of the world, but I think my problem with the EU is there is a problem with the rollout of the vaccine in the first instance. They're well documented. The spread or bringing it under control, even in countries which previously had a quite good record on it, such as Germany, is proving problematic. And that basically means, as we've seen recently with France basically announcing that restaurants and bars are going to be closed all the way through till early April, that this recovery is going to take a lot longer time. Now, we obviously have to put that in also in the context of the Eurozone's or the EC's rescue package. It probably means they will also need to do more. And I'm sure Madame Lagarde will be stressing that the onus is on the fiscal side and for deploying all those measures as quickly as possible. But in terms of the overall outlook for the Eurozone, I think it just basically looks like the recovery is going to be slower, and with it brings the big risk that all these deferrals of foreclosures, of insolvencies which have been put in place, furlough schemes, are going to cost a lot more. Companies are going to have that much more debt, and the banking system, which is obviously crucial to but financing the Eurozone, is going to have a bigger NPL problem, and that is basically something which could well restrain the recovery.
What about the inflation picture? Because obviously the latest data that we got a couple of weeks ago saw the fifth consecutive negative month for price levels in December. You said the ECB essentially needs to remain dovish. Presumably that data supports that. And what's your outlook for prices?
I think in the Eurozone, the price outlook, we're not really seeing anything feeding through from some of the bottlenecks which have appeared elsewhere thus far. So if you look at things like German PPI, there are some signs that the bottlenecks in the commodity area, broadly speaking, energy, industrials, agriculture, is starting to have some sort of an impact. But will it be enough to get the ECB to the sort of levels where it can argue that we're on a sustainable path back to 2%? It seems very, very unlikely. And simply on that basis, I think the ECB is going to be in a very dovish mode, even if it doesn't add either further rate cuts or indeed more to its PEPP and PSPP programs. So that on its own basically suggests a very, very easy policy. And I don't think the risks in the euro area of a rollback or a pushback against the current dovish policy earlier than people have been expecting, as there is a risk, say, in the US or Canada or Australia, New Zealand, is really a very real one.
So what are some of the tools that the ECB might use? Kind of what's left in the toolbox? We're starting to hear about some less orthodox proposals. One ECB Governing Council member said that they should be exploring yield curve control. What are your thoughts there?
Well, I can see, I can understand Mr. de Guindos's thoughts on that particular front, that he would talk about yield curve control. First of all, there's a huge problem, because which yield curve are we talking about here? Are we talking about the Bund curve, the BTP curve, Bono curve, OAT curve? Secondly, that sort of goes around the whole issue of the fact that they actually already have yield spread control, thanks to the QE that the ECB's been doing for the past 5-6 years. So I think it's a bit of a dead duck as a theme. It's also beyond that, I think, something which would create a lot more political ructions, this divide between hawks and doves, this idea that it would equate to something which raises the prospect of some German resistance on the basis of this is not in the ECB's mandate, even though that probably would prove to be a storm in a teacup. The other issues really are more in terms of providing, I think that the one thing which is left in their toolkit is basically looking at ways to fund corporates more directly, and finding some ways to go through that. On the other hand, we've got this other problem that the ECB is also becoming rather concerned about the fact that banks are extending loans on a leverage basis. They've got this complaint about the leveraged loan market, and they want to go after them. So, you know, on the one hand, that is an option. On the other hand, there seems to be a move against more leveraged lending.
What about your outlook for the euro? I mean, since those lows after the crash that we saw in Q1 of last year, since March, essentially, euro dollar's rallied by about 14%, but it has come back a bit off the highs of this year. What kind of levels do you think we should be eyeing on the chart?
I don't think there's any particular level that one should look at in these sorts of markets. Unfortunately, positioning is always very lopsided. I think there are two things which are, however, important. The market is very, very short of dollars. However, as we know, particularly in terms of euro dollar, there is always a focus on the 10-year yield spread. And if we are in a situation, whether it's due to the fact that people are worried about increased fiscal borrowing in the US and a steeper yield curve, or the fact that actually the way things are looking at the moment, the euro area as an economy is going to underperform, and therefore you're likely to see long-term rates stay low in recognition of that weak growth. Basically, the interest rate differential between the dollar and the euro is likely to continue to widen on that basis. And on that basis, I think the ECB will probably feel quite relieved that there's some of the upward pressure on the euro is likely to dissipate somewhat. I'm not sure that there's a huge amount. Yeah, obviously there are differences in the current account aspect between the US and Eurozone, but I think a case for a 125, 130 euro is very poorly made, basically, both on the monetary policy outlook differentials between the US and euro, and indeed in terms of the growth outlook.
So do you think that this dollar weakness story is starting to fade?
I think the dollar weakness story may actually find a new home, because a lot of the expression of people being concerned about the dollar's role in the long run has been done in the safest currencies. So people have been basically going short of the dollar against the euro, latterly also against the pound, because it seems to be a safer bet now that we've got the Brexit situation out of the way, even if there are issues with that, against the Swiss franc, against Canadian dollar, Austria. But if we are actually going into a situation where there is a global recovery, then I think actually the big dollar short will probably shift away from the developed world i.e. the developed world currencies, in towards emerging market currencies with much, and not just the Chinese yuan. And it will go more in that direction. So it's not a question that the dollar weakness story goes away, but it becomes refocused.
And very finally, let's just quickly get your outlook in terms of European equity indices in 2021. So far, the DAX has been making modest gains for the start of the year. Do you see more upside going forward?
I think on a sectoral basis, there are going to be, particularly on the exporting side, there's a lot of optimism being expressed in Germany. I think if you actually look at most of the trade numbers that we're getting out of the euro area, there does seem to be a notable pickup, and the industrial sector is picking up. So that sector should be doing pretty well. On the banking sector, it's sort of like 6 of one, half a dozen of the other. If the ECB bank lets banks actually start paying dividends, then people will chase that, because yields are hard to come by, and the valuations in the euro area banks is actually quite low. On the other hand, if we're going to have a slow recovery, then some of the sectors like related to the consumer and leisure, probably not going to recover in quite the same sort of way, even though they're probably quite fairly valued at the moment, as people might hope they will be.
All right, Mark, it was great to see you again, and thank you so much for all of your analysis, as always. And that was Marc Ostwald from ADM ISI. I'm Victoria Scholar, and thank you so much for tuning in to IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.